Hey everyone, welcome back to the channel. Today we're tackling a big question that a lot of you have asked. Are mutual funds really worth it? You see them everywhere, recommended by banks, financial advisors, and maybe even your parents. They're often pitched as the go-to investment for beginners, but are they truly the best way to grow your money? Let's dive deep and figure it out. First, let's break down what a mutual fund actually is. Imagine a giant piggy bank. A bunch of investors, including you, put their money into this piggy bank. Then, a professional fund manager takes all that pooled money and invests it in a variety of assets, like stocks, bonds, and other securities. The collection of all these investments is called the fund's portfolio. When you buy a share of the mutual fund, you're essentially buying a tiny piece of that entire portfolio. The biggest selling point of mutual funds is diversification. Remember the old saying, "Don't put all your eggs in one basket." That's exactly what a mutual fund does for you. Instead of you having to research and buy hundreds of different stocks, the fund does it for you. With a single purchase, you can own a slice of dozens or even hundreds of different companies. This spreads out your risk. If one company in the fund performs poorly, it won't sink your entire investment because you have many others to balance it out. This is a huge advantage, especially if you're just starting and you and I have a massive amount of capital to build a diversified portfolio on your own. Another major pro is professional management. You're essentially hiring a team of experts, analysts, researchers, and a portfolio manager to make the investment decisions for you. These are people whose full-time job is to analyze markets, study companies, and try to pick winners. For anyone who doesn't have the time, the expertise, or frankly, the interest to manage their own investments day in and day out, this is a massive convenience. You can set up automatic investments and let the pros handle the rest. It's a very hands-off approach to investing. Plus, mutual funds are incredibly accessible. You don't need a fortune to get started. Many funds have very low minimum investment requirements, sometimes as little as $100, or even less for subsequent contributions. This accessibility has opened up the world of investing to millions of people who might have otherwise felt it was out of their reach. So, to recap the good stuff: instant diversification, professional management, and easy access. Sounds pretty great, right? Well, hold on. It's not all sunshine and rainbows. Let's talk about the cons. And the first one is a biggie: fees. That professional management we just talked about, it isn't free. Mutual funds charge something called an expense ratio. This is an annual fee, expressed as a percentage of your investment. That covers the fund's operating costs, including the manager's salary, administrative fees, and marketing expenses. Now, you might see an expense ratio of, say, 1% and think, what's the big deal? But that 1% could have a massive impact on your returns over the long term, thanks to the power of compounding. Let's say you invest $10,000 and the market returns an average of 8% per year. Without fees, in 30 years, your investment would grow to over $100,000. But with a 1% annual fee, it would only grow to about $76,000. That's a difference of $24,000 eaten up by fees. This is the silent killer of wealth that many investors overlook. The fees are automatically deducted from the fund's assets, so you never even see the money leave your account. But believe me, it's gone. Another potential downside is the lack of control. When you invest in a mutual fund, you're handing over the keys to the fund manager. You don't get a say in which specific stocks or bonds are bought or sold. If you have strong ethical objections to a certain company or industry, like tobacco or oil, you might find it's included in your fund's portfolio. While there are socially responsible funds, your choices are limited to what the fund offers. You also can't decide when to buy or sell individual holdings to manage your tax bill, which leads to another issue: tax inefficiency. When a fund manager sells a stock within the portfolio for a profit, that triggers a capital gain. At the end of the year, the fund is required to distribute these gains to its shareholders and you have to pay taxes on those distributions, even if you never sold any of your mutual fund shares. This can happen even in a year where the fund's overall value went down. You could lose money on your investment and still get a tax bill. It is a frustrating situation that gives you less control over your tax strategy compared to owning individual stocks. Finally, let's talk about performance. You would think that paying a professional manager would guarantee you beat the market, right? Unfortunately, the data shows that's not the case. Year after year, Studies from companies like S&P Global have shown that the vast majority of actively managed mutual funds fail to outperform their benchmark index. For example, most large-cap U.S. stock funds fail to beat the S&P 500 index. So, you're often paying high fees for performance that is average or even below average. You're paying for a 5-star meal and getting a fast food burger. So, what's the alternative? This is where index funds and exchange-traded funds, or ETFs, come into the picture. An index fund is a type of mutual fund, but instead of having a manager actively trying to pick winning stocks, it passively tracks a market index, like the S&P 500. It simply buys and holds all the stocks in that index. Because there's no expensive management team making active decisions, the expense ratios for index funds are incredibly low often, less than 0.1%. ETFs are very similar. They also track indexes and have low fees, but they trade on an exchange like a stock, which can offer even more flexibility and tax efficiency. By investing in a low-cost index fund or ETF, you get the same great diversification as a mutual fund. You can own a piece of the entire market with one purchase, but you do it for a fraction of the cost. And since most active managers fail to beat the index anyway, by simply matching the index's performance, you are statistically likely to outperform the majority of your peers who are paying high fees for active management. Legendary investor Warren Buffett has long recommended that most people should simply invest in a low-cost S&P 500 index fund. So, let's bring it all together. Are mutual funds worth it? The answer is, it depends. For someone who wants a completely hands-off approach and is willing to pay for the convenience of active management, a well-chosen mutual fund can still be a reasonable option. They did, after all, popularize investing for the masses. However, for most people watching this, who are willing to do just a little bit of research, the answer is probably no. High fees, lack of control, tax inefficiency, and consistent underperformance of most actively managed funds make them a tough sell compared to the alternatives. Low-cost index funds and ETFs offer the same core benefits of diversification and simplicity, but without the significant drag of high fees. Over your investing lifetime, choosing low-cost index funds over high-fee mutual funds could literally mean the difference of tens or even hundreds of thousands of dollars in your retirement account. The key takeaway is this: always check the expense ratio. It is one of the single most important factors in your long-term investment success. Before you invest in any fund, look up its fees. If it's anything close to 1% or more, you should seriously ask yourself if it's worth it, especially when there are alternatives that charge as little as a few hundredths of a percent. I hope this critical look at mutual funds has been helpful and gives you the confidence to ask the right questions when it comes to your money. It's your financial future, and making informed decisions is the first step toward building real wealth. What are your thoughts? Do you invest in mutual funds, or have you made the switch to ETFs and index funds? Let me know in the comments below. I'd love to hear your experiences. Thanks so much for watching. And if you found this video valuable, please hit that like button and subscribe for more content to help you master your money. I'll see you in the next one.